The London silver market is reportedly experiencing almost complete lack of liquidity, as reported by Bloomberg, a prominent US financial news outlet. In order to keep their positions intact, traders who are short on actual silver are rushing to acquire it, frequently at exorbitant borrowing rates. At this time, we do not have any liquidity accessible. Managing partner Anant Jatia of Greenland Investment Management stated that the current situation in silver is completely unusual. This move is now being reported in unison by three large investment management firms, TD Securities, Greenland Investment Management, and JP Morgan. We will discuss this further shortly, but it is safe to assume that the United States may be the final country holding silver supplies amidst a global silver squeeze. The basic but potent assumption of Robert Keynes's silver analysis is that silver is the secret motor of industry and money. Silver, in contrast to other commodities, has two distinct personalities. In addition to being an important industrial resource for contemporary technology, this metal has long been used as a medium of exchange, protecting riches for generations. Because of its one-of-a-kind function, silver is in high demand, unlike nearly any other element. According to Keynes, silver's undervaluation in today's global markets is due to its dual use. He believes that low nominal prices have made investors and policymakers too comfortable to notice the impending explosive revaluation caused by structural imbalances in the banking and industrial sectors. The underlying constraints on silver's supply dynamics are something he brings up frequently. The world's mining output has leveled out, and more than 70% of the silver we see in the market is actually a byproduct of mine for other metals, such as lead, zinc, or copper. So, the production of silver would not be able to simply meet the increasing demand. When the price of silver rises, miners can't simply start producing more of the metal. The crucial role it plays in electronics, solar panels, medical applications, and electric cars is driving significant industrial use expansion. This disparity between scarce supply and soaring demand is a ticking time bomb, according to Keynes, and the market as a whole has not yet priced it in. He foresees a structural repricing in the silver market when this occurs, comparing it to the market experiences of oil and uranium during previous shortages. He also bases his prediction on the fact that the physical silver market is experiencing increasing stress. Signs that the system is subtly tightening, according to Keynes, include rising bullion premiums, delivery delays, and falling inventory on major exchanges. He claims that investors will demand actual deliverable metal and that the current abundance will be shattered by the paper silver, which is the extensive web of futures, ETFs, and derivatives. The disparity between the paper and physical markets, according to his research, will cause a short squeeze at some point, which would cause prices to spike sharply as supply decreases. According to him, this might be the catalyst that unleashes a period of spectacular price discovery for silver, which is now undervalued. In order to stay up to date on our discussions, make sure to subscribe to our channel and click the bell symbol. Please enjoy the video and thank you. Many dollars were flowing into exchange-traded funds, ETFs, in the American market. Honestly, I told them, that's just paper silver. Plus, a true squeeze wouldn't occur unless buyers removed silver from circulation. For the simple reason that the majority of silver held by ETF investors is administered out of the London market in the UK by the LBMA. And other than that, it mainly simply sits in the warehouse and is swapped around. You can't experience a silver squeeze, a situation where there is insufficient physical silver, through a paper trade or contract. The physical markets are essentially ignored in this process. It was precisely that occurred. This is Silver Squeeze 2.0, as I had anticipated. When Silver Squeeze returns, it will be because, you're physically squeezing someone, as I predicted a few years ago. Over the last, 6 months or so, more than $200 billion has been invested in the SLV Silver ETF, as I have detailed on earlier broadcasts. It finally burst in August, and then there were a plethora. All it is a collection of silver investments, really. Thus, that is how it always begins. The first to get in are the American generalists and silver investors who have savings or retirement accounts or other access to capital. Something along the lines of an E-Trade or Schwab account probably describes it. Furthermore, they intend to transfer these money in order to gain exposure to the silver price. They may or may not be attempting to accept delivery. You can't even accept delivery through many of these ETFs. Currently, we are experiencing a tightening of the market. There is no free-floating silver left, Robert Gottlieb said in a piece published in the Jerusalem Post. So that you can understand what's happening, I will lead you through this article and a handful of others before looking over the statistics. Whispers of an impending silver squeeze have resounded through precious metal circles for years, the article states. It seems the time has come, and now there will be repercussions all the way from Tokyo to London. And senior at the JP Morgan bullion firm named Robert Gottlieb stated it bluntly. There is essentially no free floating silver remaining. The metals market was jolted by that statement, which came from a highly influential insider. Worried short sellers cause lease rates to skyrocket. Compared to platinum, silver's lease rates, the interest charged to borrow physical silver for delivery, have soared by 20 to 30%. The market is often quite plentiful. Thus, this is a really unusual sign of scarcity. A new article in the J-Post delves into the present silver crunch, discussing how the scarcity in London is but a taste of what can happen when the paper silver system starts to fall apart. The TD Securities market analyst went on national television to announce the commencement of Silver Squeeze 2.0, a physical one, and I've posted about it on my channel, Twitter, and YouTube. This is making its way into international media outlets and has already made it into mainstream news. Returning to the original quote from the article, the J-Post analysis goes into detail about the important levels of both gold and silver, and how they are both showing strong momentum currently. I will return to the market's technical and psychological levels. Recently, I and other Western market analysts have been the targets of criticism on multiple media for allegedly being too preoccupied with technical trade to properly analyze the market. In fact, I'll show you that it does. That sticking to the basics and the technical aspects is essential. At some point, I think fundamentals will win out over technicals. For the past 16 years, I have written about gold and silver for Seeking Alpha. During that time, my articles were syndicated across several mainstream publications, including Yahoo Finance, NASDAQ, MarketWatch, and others, and we'll return to that shortly. It's important. Returning to this essay, the current price of banning silver, assuming it can be located, is 12%. I mentioned the iShares Silver Trust, SLV, at the start of the video. Now, the paper side of the transaction is being acknowledged in this piece. The trust is facing borrow fees around 12%, and there are no shares left too short. The suffering is getting worse for individuals who bet on a decline in price. They are losing money as prices rise and paying exorbitant borrowing rates. There is a real squeeze on these shorts in the paper market, and that's going to trigger an explosion in the physical market as well. More people are looking for supply. Proceeding further. This compression works in both directions. Lack of liquidity and escalating borrowing costs tighten the noose, while rising prices erode short holdings. see how these market reshaping processes are playing out in a linked J-Post piece on borrowing costs and ETF pressures. There is substance to Gottlieb's claim that there is no free-floating silver. The fact that almost all physically delivered silver might be leased or transferred as a result of long-term commitments in ETFs, industrial contracts, and other similar arrangements is reflected in this. This has been going on for a while and will continue to happen, as I've mentioned on my channel on multiple occasions. Very nothing is still free or unfettered. The effects on international trade and delivery have been highlighted by one J-Post inquiry into the physical scarcity of silver. The next piece is going to be published by J-Post. The United States of America ships silver bars to London in a record-breaking squeeze. As prices of silver surge beyond 50 Rs due to a historically tight market, the United States has sent bars to London. Unprecedented global silver stress is shown by physical shortages and skyrocketing premiums. As a result of a dramatic physical scarcity in London, the report claims that the world's silver market is in the midst of a never-before-seen crisis, necessitating the transatlantic shipment of silver bars from the United States. In a move reminiscent of the notorious Hunt Brothers squeeze of 1980, benchmark silver prices have soared past 50 Rs, the second time a precious commodity has ever reached such levels. London faces liquidity problem. It had previously struck London, incidentally, when rumours circulated that the city lacked sufficient physical silver some 6 or 8 months ago, or even a year ago. The precise date evades me. The LBMA website chart showing the falling silver holdings was something I had been reporting on. Not all commitments are publicized, so we couldn't tell from that chart how much was previously committed to ETFs and other private contracts. Nonetheless, the free floating was decreasing, as shown in the data pertaining to London inventories and ETFs. I must have done that 30 or 40 times in the past 2 or 3 years just by perusing Sue's charts. It has finally hit. The disparity between claimed silver and free-floating silver on the London market has now reached a crisis level, and we are witnessing the consequences of this as more and more of it has gone into exchange-traded funds, ETFs. The London silver market is reportedly experiencing almost complete lack of liquidity, as reported by Bloomberg, a prominent US financial news outlet. In order to keep their positions intact, traders who are short on actual silver are rushing to acquire it, frequently at exorbitant borrowing rates. When looking at the world economy as a whole, Keats sees the global debt cycle and the decline in trust in fiat currencies as causes for silver to do well in the long run. Trust in paper currency, in his view, will keep dwindling, so long as inflation remains high and central banks keep printing money to prop up hyper-indebted economies. Despite gold's inherent advantages, silver's dual role as a money and industrial metal gives it a better chance of outperforming in percentage terms. He likens silver to poor man's gold, describing it as a safe haven for regular people who are worried about currency debasement. When things go bad, silver is more than just a hedge against inflation. It becomes a real protection against systemic instability and a means of financial independence. Keats also recognizes the ebb and flow of silver's value, viewing it as a test and a blessing. Silver, with its relatively little market, has a tendency to amplify price swings in either way. This means that although corrections can be harsh, patience pays off for long-term holders. He warns that prices might be momentarily distorted by institutional manipulation, suppression of derivatives, and short-term speculative fluctuations. He recasts these swings as chances to stock up on silver before anybody else notices how rare and valuable it is. Trades in exchange-traded funds, ETFs, drain silver supply from the market. In just 6 years, the amount of silver available has dropped from more than 850 million ounces in 2019 to a meager 200 million ounces today, a reduction of 75%. A move in demand away from Hong Kong and toward London due to a surge in purchases made by Indians during Golden Week. This is par for the course, given that India has placed import limitations on gold and has consequently required a great deal of silver. Although silver was the more popular metal, people still traded love tokens made of both gold and silver. China shares this view as well. Around this time of year, it takes place. The high physical demand in the Asian and Indian markets is a contributing factor to the periodic rise in the prices of gold and silver. Silver has soared over its prior all-time non-inflation adjusted high of $50 Aussie, caused by the acceleration of the squeeze. I also anticipate it to keep going since we haven't reached the inflation-adjusted high. A further factor is the uncertainty that could be induced in global supply due to the possibility of US tariffs on silver imports. Remaining metal in circulation has decreased to 200 million ounces, a 75% decrease from 2019, according to Bloomberg. Even ETFs have put a halt on further investments. The scarcity of real silver on the home market was the reason given by Kotak Mahindra Asset Management, who also noted that premiums were significantly higher than foreign benchmarks. Areas with greater premiums are beginning to emerge as a result of the unique dynamics of local supply and demand. It's something I've predicted for the precious metals markets for a long time. The markets will fragment into regional markets regarding premium pricing and physical deliveries when demand surges and physical squeezes occur, removing London and Necomex from price regulation. As a result of regional differences, we are witnessing the United States fly bars to London. The real price you pay, known as premiums, will no longer be dictated by two global financial centers. That is currently evolving. Additionally, those pricing systems will relocate eastward to Dubai, China, and India, rather than the BRICS countries. As stated in the report, the London Bullion Market Association has recognized the tight silver market and has verified that it is closely watching the situation. Dislocations in prices hit record highs. Significant price and trade disruptions have resulted from the strain. The premium for spot prices in London over futures in New York has increased to $3 Oz. The reason scalpers will enter the market and participate in this trade is because if London is higher than the US, they will do it on paper, which will make pricing issues worse and lead to the separation and eventual fading of the once unified pricing model between London and New York. Once again, real physical trading on a global scale will take a back seat to these various localized marketplaces. Futures and spot prices on the London and COMEX markets, as well as their degree of correlation, will thus no longer serve as the only determinants of spot pricing. Yeah, I should probably mention that. The interest rate on overnight loans has soared to almost 100%, which is much higher than the levels witnessed during the Hunt Brothers squeeze of 1980. As banks stop quoting, the bid-ask spread has grown from a few cents to more than 20 cents per ounce, which is very wide. It made headlines because multiple banks stopped quoting. No bank wants to quote another bank. Therefore, the quotations become very broad, according to Robert Gottlieb, a former trader at JP Morgan. Why? This is due to the fact that the derivative markets and regional variations in demand and supply affect pricing differently. Because of it, I understand. All right, that article delves further. We will continue. A Bloomberg article is available. Although this was an early report, the upcoming Bloomberg piece on Yahoo Finance is even more impressive. I will not reveal the premium edition, though. As a result, let me simply demonstrate how silver traders hurriedly sent bars to London. Squeeze Rock's market is a historic place. So sure, We will be sending them from the United States to the United Kingdom.